Hello traders, Gary Wagner here at just about 2:30 in Honolulu, 8:30 in New York. It is Thursday, May 14th, 2020, and this is the Daily Report for Gold and Silver. We had a sizable surge to higher pricing in gold today as it broke through the compression triangle we've been speaking about for the last couple of weeks. It broke through with a fever, moving it up about $20. Currently, as I said, we're sitting around $17.42 to $17.40 in that area. On today's show, I want to cover three critical areas. The first is what triggered the buy signal itself. The second topic we need to discuss is where do we place our stop, so if the trade is not in our favor, we have the least drawdown possible, while at the same time protecting us from normal ranges within the day. And then lastly, I want to talk about our exit strategy and our various price points we will look for over the next month. Let's take a look at the price board, and then we'll talk about our trade when we pull up our technical studies. Traders, we certainly saw follow-through buying occur today in gold. That was one of the prerequisites for triggering a buy signal, was a break to the upside based upon the compression triangle. The net result of today's breakout to the upside, as identified with the compression triangle, was that we saw a solid move in gold. It is trading up about $29. We are now looking at Australia, which is just open, down $2.30, 17.3860. Spot price in terms of gold is 17.30 and 12 cents. Platinum closed at 728.60. Palladium also gained 1813.60, and then the dollar had a fractional effect on the marketplace itself. Traders, lastly, silver had a moderate gain today, $16.20 after factoring in 4.5-cent rise that occurred in trading today. Let's take a look at our technical studies. We will talk about the trade we put on this morning, our expectations or hopes to the upside, meaning our exit strategy if we're right, and why we placed our stop where we did. In the 35 years that I have been involved with the financial markets, specifically commodities and technical analysis, what we have seen in terms of the way this compression triangle unfolded is something I've not witnessed before. And what I'm referring to is typically you will get the break, and that will occur just prior to gold pricing reaching the actual apex of that triangle. So typically we might see a breakout here or here, even these two areas, which is to say that on many occasions you will see the breakout, whether it is a break to the upside or a break to the downside, anywhere between 2 and 4 candles on a daily chart. This time was different, because what happened was just prior to reaching the apex, we had this one large green candle that basically closed near the upper level resistance line and really opened right around the support line. The next day it challenged the resistance line, opened there and closed lower, and we had the occurrence of 3 consecutive days opening at the support line, but the ranges narrowed up until it reached the apex. So we actually got to the apex with no clear identification of a break one way or the other. That all changed today. We had the market move to just about the resistance line that occurs at the series of lower highs. And if you recall from yesterday's show, my comments were if we see follow-through buying today, that would trigger a buy signal, because the breakout is suggesting that we should see a fairly strong rally occur from today forward for at least a couple of weeks. In fact, we did send out a trade recommendation, and we recommended that our traders buy June gold at the market. I want to talk about our stop and our upside target, but we did enter at 1742. The market is currently 1741.70, so right in the same price point. Next, I would like to address our stop, why we put it where we did, and the belief that that stop should hold if the market continues to go up. Of course, we've had wild price swings pretty much all along the way. You can see it trading at support, then it breaks above resistance, it goes back down, it goes back to resistance, and then it kind of levels out, as you can see right in this area. However, what we wanted to focus upon is the most important component of recent trading, and that is this very, very large green candle, because that represents really the biggest part of the breakout to the upside. And when we do that, we want to decide what is a logical place to put our stop. So what we did is we looked at recent lows that came in just before we had that significant breakout. That price is approximately 17.15. You can see we have a whole series of pricing that is sitting right at that area. And my sense is, as long as the market continues its upward trajectory, we will raise our stops, and this stop should most certainly hold. And that leads us to the third and final component that I want to talk about today. We explained why we bought, we explained why we placed our stop where we did, and now I want to tell you what our current exit strategy is. As we can see, there are a series of tops that are above the recent highs. Now, I'll try to draw an arrow as straight as possible, and then we can see those areas. So, the market was here. This is the first of the market opening above that, which takes us to our exit strategy, and I am basing it upon a series of highs that came in, the first of which we can see occurs at these two candles here, and it comes in roughly at 1770. Everything prior to that, except for this one top at 50, is actually coming in above current pricing. So we have 1750, 1775, and then 1788. That's the record high for the year. But I truly believe that there is a high probability that we will inevitably reach, challenge, and break $1,800 per ounce. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the daily update and review. Bye-bye.